Welcome back to the channel. So in today's video, I'll be covering how exactly I would restructure my entire portfolio if I had to start all over again. So for reference, this is my portfolio here. In today's video, I will only be covering stocks I would buy at today's price. So this was actually an interesting comment here. It says, "Hey Guan, thank you for all your great content. It is so helpful. I think a cool episode would be what you would do if you were starting all over again, what you would buy, and what your cash allocation would be at current market valuations." So let's talk about the market valuations first. Your markets are historically on the higher side. So your S&P 500 forward PE is currently at a 22 times. And based on Aswaf Damodaran, this is his valuation here, the markets are currently around 12% overvalued. So he has the intrinsic value at around 6,000 points on your S&P, but your S&P now is currently trading at around 6,700 points, which means the markets are around 12% overvalued. And he has also said that the markets are fairly highly priced, similar to what Jerome Powell has said. So because of this, how much cash should I hold in my portfolio if I were to start all over again? I think there are very little opportunities in the market today. Of course, I would always look for opportunities to deploy, but I would also like to hold a substantial amount of cash in case the markets go into a downturn. So I would hold around 25% cash to wait for a better opportunity to enter into the markets. I think the opportunities today in the US markets are quite limited. There are many different companies running without fundamentals, and a lot of the valuations are overstretched as well. So for my cash position, I would hold around 25% cash, slightly lower than what I currently have right now, although I'm still trying to deploy into the market. So for my buy ratings in my portfolio today, here are the stocks that I would buy at today's current valuation. So I would buy Visa, I would buy S&P Global, Warren Co, FICO, MasterCard, as well as Otis. As for the Singapore portfolio, here are some of the companies that look interesting as well. Some of them are undervalued. So the first one is SIA, Singapore Airlines. I think it is one of the companies in Singapore that is still lagging behind the index, and overall the stock is undervalued. I have Fraser Centrepoint Trust here as well. It is a hold for me. I have UOB. I think the company is a buy today. And I have Wilmer down here as well, which is a stock that isn't really talked about, but the stock is really cheap. So let's talk about how I would structure this portfolio. So overall, I would say I'm quite risk averse. So I'm looking to allocate the stocks based on the downside risk potential. So a quality business is what I normally lean towards, because your quality businesses, you'll be able to grow for a sustained period of time. And when they can grow for many years, your terminal growth rate will be higher than a typical S&P 500 company. So for example, Moody's has been growing for 10% over the past 60-70 years already. It is something that I'm sure a lot of investors didn't predict 60 years ago. And that is why the company has been able to compound at such a high rate over the past 60 years. So what I would plan to do with this portfolio is to aim for high quality businesses that are undestructible, that are undisputable as well, with incredible moats that will stay for a very long time. So let's talk about the first two companies that I would add. It will be Visa as well as MasterCard. These two are your stalwarts, as Peter Lin says. So Visa and MasterCard, they're basically your rails, your payment rails. And these two companies are almost undestructible unless this crypto mania continues for the next 10 years, which I think is unlikely. So Visa and MasterCard are two companies that I would add at today's price. And Visa in particular is trading at a decent valuation today. So I will lean more towards Visa and less towards MasterCard. But nonetheless, these two are quality businesses. I would say they are the top 5 business model in the entire world. And that's why I would add into these two positions. The next company that I would add into as well is another stalwart. It's S&P Global. So S&P Global, there are many different business lines. I know I sound like a broken record. There are many different businesses that are undestructible. So they have the credit rating portion, they have the indices portion, they have the data portion that is slightly weaker in terms of moat, but it is a highly predictable stream of revenue coming in every single year as well. So for S&P Global, I think this company is a high quality one. It's a company that will go through cyclical downturns with the interest rate environment. But overall, this company is one that will stay around for the next 60-70 years for sure. The next category of stocks that I would hold as well in this portfolio is FICO as well as Amazon. FICO is an amazing company, incredibly high growing. Amazon is a Max 7 company that is underpriced today. I would say Amazon, out of the Max 7 companies, is probably the closest to a buy today. And that's why I've included Amazon in this list so that there's AI optionality as well. So if your AI play continues on and on, then Amazon, being one of the AI players, will definitely benefit from this. So you're sort of able to participate in this AI bubble if it ever comes as well, if you hold Amazon in your portfolio. So Amazon is a company that I will add into as well at current valuations, as well as FICO. As for FICO, here are some news that I would like to cover. So FICO is down around 8% today, currently trading at a 67 times of earnings. So for FICO, why exactly is it down? It's down because Equifax has basically struck back with their lowered credit score pricing as well as their new model. So what they've done essentially is they've maintained their Equifax Vantage score prices. So they're saying that it's now $4.50, more than 50% below FICO scores, and they're holding the prices for the next 2 years at this current stage. And what they're also doing is that they'll give out free Vantage score whenever there's a FICO score that is bought through them. So Equifax over here is trying to paint the picture that FICO is raising prices at too high a rate. I think Equifax is honestly full of shit. They're the ones that are increasing the prices. They're the ones providing the markups. And what FICO has done is brilliant. They're trying to bring in all the economics to its own company instead of having to go through the markups of Equifax. So I think this is a nothing burger for FICO. And overall, this company has been incredible in terms of pricing. And if you're to look into the valuation today, assuming this $10 holds, given what Equifax has done over here, they're trying to paint FICO as the bad guy. So this will lead to FICO basically having to put in the $10 pricing on Equifax as well. So if you're to assume the FICO score next year is at around $10 a share, so that will mean that the revenue in the credit score portion will increase by 100%, more than 100%. And assuming the net income in that portion grows by around 100% as well, this will mean that the stock price next year, the stock price on a forward PE ratio basis, is currently now at a 35 times of earnings. So this probably doesn't look all that expensive. And that's why I think FICO at today's valuation, although it sounds wild that the stock is trading at a 67 times of earnings, is probably still a buy at current valuations. So that is why I would allocate a small chunk of my portfolio if I were to restructure it into FICO as well. The next set of companies that I would own are dividend companies in Singapore. So in Singapore, there's no dividend withholding tax. Even if you're a foreigner that is investing in Singaporean companies, there's no dividend withholding tax here. And a lot of the companies, they give out high dividends. So for example, Fraser Centrepoint Trust, UOB, they give out at least 5% dividends every single year. And this is what I collected as dividends just last month. So I collected around $300 worth of dividends from two companies here. One of it is Capital Land Integrated Commercial Trust, and then the other one is SIA, around $300 in total. So in Singapore, what I'm trying to build towards is a dividend portfolio. A dividend portfolio that will allow you to retire. And I think a reasonable sum will be around $5,000 every single month, giving out around 5% dividend yield. So you would require around $1.2 million. My Singapore dividend portfolio right now is still relatively small. It's around $21,000 cumulative. So as I grow older, I would plan towards trying to shift some of my US equities to more of the Singaporean companies to give out more cash flow every single month to set myself towards the retirement goal. And currently the goal would be around $1.2 million at around $5,000 of dividend income every month. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what are you doing with ASML? Is it too early to sell right now? I think ASML is a company that has benefited massively from the news over the past 1 month or so. So you had Intel coming up, you had a lot of developments as well, and then you have your analyst upgrades and so on. So for ASML, I think the company is about fully priced right now. It's probably around fair value. I think for the company today, it's a hold for me. I wouldn't necessarily sell into it. The earnings are up next week, so we have to see how that one plays out as well. But overall, ASML is a decent, high quality company. Although the company is no longer undervalued, I think the company today as a whole, I wouldn't rush to sell this company unless it goes to a 40, 50 times of earnings. And that will be a different story. I think ASML at a 35 times of earnings is probably about right given the mode of the business. The next question, it says, any ETF that might be good. So I think for ETFs in general, the one that I would lean towards is SCHG. Is your growth ETF by Schwab. So that is what I've been buying when I'm managing someone else's portfolio. So SCHG is probably the one I will lean towards, the one with the lower expense ratio. As for S&P 500, if you're looking to buy into one as well, and if you're not a US citizen, I would recommend CSPX. It's your S&P 500 in Ireland, but your dividend withholding tax will be a lot lower. It's not 30% of the dividends. It will be around 15% of the dividends if you buy CSPX. So those two ETFs are the ones that I would recommend. I wouldn't recommend going into factor ETFs, into leverage ETFs and so on. I think if you're just dollar cost averaging, just buy SCHG as well as CSPX. I hope you guys have found this one useful and invest.